Hi and welcome to Swissquote's Daily Market Talk. It's Friday, May 30th. Talks regarding whether Trump's tariffs are legal or not are heating up, with many courts involved in the decision at this moment, making the visibility worse than before. So early optimism is gone, risk assets are under pressure again, while economic data from the US doesn't help soothing nerves. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own, and this is not financial advice. So it turns out that the early trade optimism yesterday, triggered by the US Court of International Trade deeming Donald Trump's tariffs illegal, was too good to be true. The things got rapidly messy indeed after Donald Trump appealed the decision, and the US Court of Appeals posed a tariff ruling to give time to review and analyze the arguments from both parties. So we're here right now. Meanwhile, a separate federal court in the US issued a similar but more limited ruling on tariffs. As a result, the decision yesterday that canceled Donald Trump's tariffs was posed, and uncertainty in the markets spiked, obviously, because right now, nobody out there knows what's legal and what is not legal in the US for these tariffs. There are reports suggesting actually that Donald Trump's administration could still find the right clauses in the law to keep their tariff policy in place. Now, one of the most cited ones is the Section 232 of the Trade Expansion Act of 1962 that would allow the industry-specific tariffs on cars, steel, and aluminum, for example, to remain valid. Others, like the Section 301, would allow the president to deal with unfair trade, while the Section 122 is apparently designed to deal with deficits and to protect the US dollar. I mean, there are right now a lot of laws and sections flying in the air, and most of us are not lawyers or we are not legal experts, so we do not necessarily see or understand where things are going right now. What we understand and feel quite precisely, however, is that this is just too much unknown and increased volatility and uncertainty on what the US government could do and how the other countries, the trading partners, could respond. Because if the tariffs happen to be unlawful, the trade partners of the US will be, willing to make less concessions on trade negotiations during this critical trade negotiation period. Because, if you don't need to, you will not make concessions, right? And it is to be seen whether there will be any clarity on the legal side of the story before, the June 9th deadline, for example, for the European negotiations, which could or could not end with 50% tariffs on European exports toward the US. So it's that heavy cloud of uncertainty that wiped out the early risk on rally yesterday. The S&P 500 rapidly erased earlier gains, though the index managed to close yesterday's trading session some 0.40% higher than where it started, while Nasdaq 100 could keep a 0.21% of the gains in its pockets from the 2% rally that it recorded earlier, as Nvidia finished the day more than 3% higher and a touch below the $140 per share level. Besides, better than expected earnings and forecasts released the day before and confirmed that the strength of AI demand globally was enough to cover up the Chinese losses at Nvidia. The US Department of Energy also announced yesterday a contract with Nvidia and with Dell to build a new flagship supercomputer for National Energy Research Scientific Computing Center. So Dell gained around 2% in the after hours of trading yesterday, and the stock price is now preparing to break above its one-year descending trend range. Elsewhere, the Dow Jones Industrial Index remained little changed yesterday in face of the tariff uncertainty, while the Chinese and the Japanese stock markets are giving back yesterday's gains as the US and European futures are slightly in the negative at the time I am talking here this morning. So the situation is not chaotic, mind you, but it is not ideal either. The uncertainties regarding the US fiscal and trade policies obviously continue to weigh on the US dollar this morning, while the impact of the aggressive Trump policies, both on the trade and government offices, start to show quite clearly in the economic data. Because the data released yesterday in the US actually confirmed that the US GDP contracted in the first quarter of this year, the spending growth more than halved, and the deficit in the US ballooned, of course, as companies in the US rushed to import products from outside the US before the tariffs hit, and inventories actually built up. Meanwhile, a price gauge actually showed and confirmed a sharp reversal in the price pressures in the United States. Then Trump met with the Fed President Jerome Powell yesterday to force him to cut the interest rate. So the US 2-year yield actually slipped below the 4% psychological mark yesterday on rising dovish Fed bets. But the man won't cut the interest rates when it sees the uncertainties on the trade front get worse by the day and the price pressures increase. Now, most companies in the US already warned, mind you, that they will be reflecting the additional cost of tariffs on their prices. And most companies outside the United States say that they will also add the tariff cost on top of their price tags. And add to that the rising shipping costs due to the heavy disruptions in trade flows. Well, the direction is pretty clear. The prices will rise in the US. One hope is that they may be temporary. So the rise could be temporary, but the prices will rise and keep the Fed's hands tied probably until more clarity. As such, today's set of PCE data, so the Fed's favorite gauge of inflation, could be soft or even better than expected, but we will know that the full impact of the tariff tsunami has probably not hit the coast just yet. So the economic data, the inflation data, should be taken with a pinch of salt before today's closing bell. Now, speaking of inflation, the price situation in Europe is quite different than in the US. In fact, we expect to see a divergence in inflation dynamics between the US and Europe, as the tariffs don't affect the European consumer prices because they are not effective in Europe, and the euro's notable appreciation reduces the energy and commodity costs for the European consumers, and the Eurozone economies are expected to reveal softening inflation numbers today as a result of all of these factors for April, after a surprising uptick the month before. And sufficiently soft figures should keep the European Central Bank, those convinced about the continuation of the monetary policy easing in Europe, that should in return continue to give support to the European growth narrative and also give support to the single currency. And finally, speaking of energy prices, US crude is wavering a touch above the critical $60 per barrel level this week, as OPEC is preparing to announce its third big output restoration during this weekend. The cartel is expected to bring 411,000 more barrels to the market in July, and that's the equivalent of 1% of the current output, to meet the rising global demand, according to their official communique. But we obviously all know that the official communique makes little sense when demand around the world and the demand prospects are waning under the heavy weight of global trade tensions. So OPEC is either trying to please the US President Donald Trump or trying to punish the members who actually failed to comply with the quotas over the past years of output restriction. But whatever it is, if the trade tensions around the world remain or rise, a rising supply from OPEC will have the power to pull oil prices sustainably lower. So we could see US crude lose another $10 per barrel into the second half of this year. Voila, that is a story to be watched during this weekend. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week. And until then, good day trading and have a lovely weekend.